Hi, this is Ben Reppond. Welcome to my YouTube broadcast. Today is November 27, 2024. So I wanted to say I have been traveling and I'm with family this week. And so I've not had the time to do the research for the Tuesday video that would normally have come out on the 26th. So that one's not going to happen. But I did want to do this one. It doesn't take me as much prep time. And and I captured the information. Most of it is through this morning, actually, the 26th. I'm recording it on the 26th. And, so I'm going to give you, in some cases, a week's worth of information or so forth, but it's through today, not through last Friday in some cases. So the other thing I wanted to do is to comment on the market. The market had, you'll see this in the data, the market has been um, continuing to move upward. There's optimism in the equity markets. And of course, I shouldn't say of course, there's pessimism in the bond markets. So bond yields are going up, generally speaking, and interest rates are going up. And of course, bond prices go the other direction, they're going down. So, but equities have been doing very well. We've been fully invested. We try to stay in the index, which is the strongest, and so we make shifts from time to time from value to growth and vice versa. But basically, it's a good report. You know that if you follow the markets and or you look at your investment account. So with that, I will jump into um, the slides here. This is the um, as of this morning, I'm recording it on the 26th. As of this morning, the 26th, for the past week, you can see that all of the indicators are positive. I did comment that bonds have been down. They have been down. This week was an exception, but generally speaking, they're moving in a downward direction. And the other thing that's been hit a lot, which you'll see through here quite a bit, is that foreign markets are not doing well. The dollar is strong, the US economy is generally strong, but the stock market is strong. A week or two ago, I read where the stocks, the equities, I assume this is the S&P 500, was 35% higher than its mean. Well, that's pretty high. Well, guess what? It's gone higher. So I don't know how much above 35% it is, but it seems like it's gone up. So valuations are getting higher. And does that create risk? Well, at least not now. So the way I see it is, for me, stay invested as long as the trend is up, and then one day it won't be, and have a strong defensive position. But when you look at this, you can see the last week is positive. You can, in the yellow box, in the pink box, the S&P, Nasdaq, Russell 2000, all above 20% for the year, and the Dow above 18% for the year. Emerging markets and developed markets have dropped off. They're underperforming. You can see it in the pink box, but to the right of that, you can also see it with the where they are relative to their 20, 50, 100, and 200-day moving averages. Um, seven, 7 out of 8 of those are negative. And of course, then you can see bonds at the very bottom. Yeah, it moved up and is above its 20-day, but it's still definitely below its 50, 100, and 200-day moving averages. So the losers right now are foreign markets and fixed income bonds. The S&P 500 breaks down into 11 major markets sectors, and the performance of those 11 sectors is about in the middle of the page in the yellow box for this past week. And to the right of that is the pink box, so you can see how they are ranked year to date. Every one of them in the pink box is positive year to date. Strongest being financials. It drops quite a ways down to industrials, consumer discretionary, technologies, all the way down at fourth position, etc. They go all the way down. The weakest is basically a defensive sector, which is healthcare, and it's only up 6% for the year, but was up 3% for the week. But you can see across the bottom to the far right that healthcare is below all four of the moving averages. This is the chart, a line chart of the S&P 500 showing for the last 30 months. So this would be 2.5 years. And I drew a black line so you can see where it is relative to that 20 period moving average. One move is a 1 week period. And but it has stayed above the trend line for a long time. And, it's going up. So that's good. When I convert that over um, to the candlestick chart, you can see there's a little doji at the very far upper right. You can see that, and but it's basically still moving in an upward direction, positive, and it's the same chart just put on candlesticks. But when you see the number of red candlesticks compared to the clear ones, you can clearly see that the weeks that there are definitely more weeks that are positive than are negative. No surprise in an uptrending market. The On a relative strength basis, Nasdaq 100 being the numerator, S&P 500 being the denominator, you can see over a 30-month period that same 30-month period, it generally has gone up. But when you look for the past, what, 5 months or so, I put a black arrow so you can see the direction of the market is moving, or excuse me, the relative strength. So when it goes down, it's the favors the S&P 500. When it goes up, it favors the Nasdaq 100 growth stocks. So it has not been favoring growth stocks, and probably I'll show you another chart a little bit more on the value side. So lately, but and that is below its 20 period moving average, which says to me that at this point, unless things change, value is going to continue to stay stronger than growth. And I shouldn't say value. It's S&P 500 is a combination of growth and value, but it is weighted more, definitely more with value than with growth. This is where we take the value and growth and put those against each other. So the pure growth, which would be Google, Apple, Amazon, Facebook, etc., as the numerator, value is the denominator, the more old economy companies. And when it goes down, it's favoring value. When it goes up, it's favoring growth. Again, similar type chart. It seems to me the trend is a little bit more in the past 2 or 3 months, a little bit more in the upward direction, which is favoring growth. But it depends on what period of time you're looking at. The S&P 500 on a relative strength basis against small cap stocks using IWM ETF as the surrogate for small cap. When you look all the way back to July of this year to present, you can see that it's moving in a downward direction, and what that does is it's favoring small cap. Small cap, and you've seen it in the past data, but I'm going to show you some more data that will support that. Small cap is doing well right now. But I guess you'd say if you looked at it over this entire period of time, you'd say, okay, well, maybe S&P is up, but the shorter term trend is small cap is up. The government bond, long-term government bond represented by the ETF TLT in the 5-year chart. Yes, you see that little tick up at the end, and that's positive for bonds. But the overall trend, the short-term trend at the end of the chart for the past, month or two, and the longer-term trend over the 5-year period are all negative. So I would say until something changes to convince me otherwise, I'd say bonds are not in favor, particularly, well, I think government bonds and even sometimes even more so corporate bonds. So people who have a traditional 60/40 buy and hold stock bond portfolio, um, you see this is a 5-year chart. So when you go back, that last drip down at the end where it's crossing back down, back through that moving average, uh, that period of time in particular, if you're looking over the past few months, you would know that, you know, that your portfolio may be up. If so, it's very little up because bonds are putting a pretty big drag on it. There probably, undoubtedly, are portfolios that are down because bonds are putting such a drag on them. People don't know what to do with this. Financial advisors, I don't know about each one of them, but if I were one, I would be very frustrated at this. This would be, you'd be getting phone calls frequently, and they would not be nice phone calls. So yeah, I, it's another reason why I don't like buying whole portfolios, um, and particularly 60/40 stock and bond portfolios. Um, Probably another reason why Warren Buffett doesn't like them. And large financial institutions like a Yale and Notre Dame don't like them. Same reason. They put a drag on the portfolio. Okay, US dollar is represented by the ETF UUP, continues to go up. It is moving up a lot. So that is measured against other currencies. So in in foreign countries, you know, when you're spending US dollars, those dollars are going further and further. So I was talking to, I think it was my daughter, and she was talking about in Japan, the dollar is going a long ways, and prices are actually prices of real estate, and like they went out to dinner, and everything is really getting cheap in Japan, and amazingly cheap. And so they're even looking at buying some property there. And I mean, so why? Two reasons. The dollar is stronger against the yen, and secondly, they're going through, well, they're just going through a lot of issues. I mean, the replacement rate in Japan, I'm not going to quote it. I don't know it off the top of my head, but you know, they're not having the babies to replace the people who are dying. So the population is declining, and they're looking at doing measures to incentivize Japanese to marry foreigners and to have babies. People that normally they would never consider letting in for residency. And this is anecdotal, so but none of that surprises me. And the yen is a part of the issue. They're paying a price for that in the currency. Okay, gold, 30-month chart, had a negative week. You can see that tick down at the very end. Um, and then, um, but generally speaking, gold has been moving up and is above its 30-period moving average. And as I record this today, it's up again today. But I would look at that tick down as a pullback. Silver, somewhat the same thing, still barely above its moving average, but it's more volatile. I think that's the one thing I see, and the difference in those two charts is silver is definitely more moves up and down more, and um, but it also had a negative um, last 5 days. Bitcoin pulled back a little bit. You see that the tick down at the end, but it has had a big run on it for the last month or so. So volatility index. So while there were some pullbacks on some of these, the equities themselves were mostly positive. And because they were positive, the volatility index dropped. So you can see that at the far right of the chart, coming all the way down. I mean, I did this morning, a volatility index number of 13. That's getting pretty low. So again, favorable for equities. Asbury Research. Last week, uh, this was 3 and 3. 3 were positive, 3 were negative. And as of right now, um, they're all 6 are positive. Again, matching what we've been looking at. The cross-set relative performance chart is showing the 3 columns to the right, the last week, the last month, the last quarter. You can see that stocks stronger than bonds, high beta, high volatility, higher than low volatility, small cap stronger than large cap, the S&P 500, and we saw that on the small cap slide. Blue chips, the Dow stronger than the Nasdaq 100. Excuse me, stronger than the S&P 500. The U.S. is stronger than both the developed markets and the emerging markets, especially the emerging markets. And this has been, um, you know, good for the U.S., but in some parts of the world, it has not been as good. Government bonds are stronger than corporate bonds, even though stocks are stronger than bonds. But the government bonds itself is stronger than corporate. High yield stronger than low volatility. Excuse me, I apologize. High yield stronger than uh, high high quality. So the junk bonds are doing better, and they tend to be more correlated with equities. So when equities are doing well, which they are now, you're going to see high yield bonds typically doing better than high quality, and short term um, bonds are doing better than long term bonds. U.S. versus the world. So the one country that's better than the U.S. for all 3 time periods is Canada. The last week, the last month, the last quarter. You can see that toward the top of the slide. The U.S. has been stronger than Chile, Peru, Mexico, Switzerland, Italy, Germany, Spain, France, the Eurozone, Malaysia, Japan, Hong Kong, Taiwan, China, Thailand, and the Pacific. And finally, the emerging markets. No surprise there. So, yeah, the US is showing strength in all 3 of these time periods. When you look at the US SPY versus EWY, which represents South Korea, look at the amount of time over this period of time. This goes back to um, September of 2022, so this is about a 2-year period of time. I look at how much time it's above the 20-period moving average, representing strength for the U.S. equity market. Gold and silver, as of today, the spot price for gold was 26.29, a gain of 2.4%. Now, I showed you on the chart where it was down, but the time period I'm measuring, because I'm doing this a little bit off cycle, is different. So gold spot price is 26.29, silver 30.49. To that, you add the retail markup. Um, both of those are slightly stronger than the previous week. The gold silver ratio is 87 to 1. A monster box of silver, 500 rounds, 1 ounce rounds, is 15,855, including $1.29 per ounce markup over spot, and bringing the retail price to 31.71. This is thanks to my son Preston. Well, we've had a change in our government. We haven't had a change yet, but we elected a new type of government. And but the one thing that I've been critical of is both Republicans and Democrats is spending too much. They both just seem to spend, and driving our debt higher and higher. You don't hear many people talking about it. So we will see with the new administration, if they're going to tackle this and start to bring it in a downward direction, that would be awesome if they did. Uh, and but right now, yeah, it's it's not going to go forever. And by the way, we're not the worst. There are 7 or 8 countries worse than us, and uh, but we're among the worst. And we are decline on an annual basis. Our budget deficit, is running about, last time I looked, around $2 trillion a year, with no seeming desire to slow that down. I don't hear people talking about it, or if so, it's not wherever I'm reading. So, yeah, let's hope for something better in the area of debt reduction, because that's a key for preserving our economy and maybe even our way of life. So, thank you for watching. Sorry that I have not been more available this week to do the other video, but it's a week with family, so um, I'll try to get back at it next week. I'm traveling next Monday, so we will see how much I'll be able to put together at that time. But thank you for watching, and good luck with your investing. Thanks. Bye.